Welcome to another podcast of the Riffle series. The Riffle, a podcast series brought to you by 10 Leaves.
And we have a really fascinating deep dive lined up for you today.
We really do.
Yeah.
So yesterday, which was May 11th, 2026, the DFSA dropped this document that honestly sounds like a guaranteed cure for insomnia.
Oh, yeah. The title alone is rough.
Right. It's literally titled Feedback Statement on CP 167. But if you actually crack this PDF open, you realize pretty quickly that you aren't just looking at, dry financial jargon.
No, definitely not. It's basically a total rewrite of the DNA of global banking accountability.
Exactly. So our mission for this deep dive today is to extract exactly what this means for you, whether you sit on a board in the DIFC right now or you just, want to understand the invisible forces that are shaping the global banking sector.
And, the timing of this release is probably the first thing that really jumps out. The DFSA, the Dubai Financial Services Authority, they aren't just tweaking their rulebook in a vacuum here.
Right. They're reacting to something bigger.
Yeah, a massive tectonic shift, really. Because back in April 2024, the Basel Committee issued a huge update to their core principles.
The BCP.
Exactly. And the BCP is essentially the global constitution for banking supervision. So when Basel updates the rules, Tier 1 financial hubs absolutely have to adapt.
So Dubai is basically overhauling its framework to make sure the DIFC maintains its status as, a gold standard jurisdiction.
That's exactly it. They have to keep up.
Which means, for this deep dive, we really need to look at how these new rules fundamentally alter the landscape for accountability and risk tracking and, transparency.
And what's really striking to me is that this isn't just about tweaking capital ratios or, math.
No, it's way more personal than that. They're zooming right into the human element of corporate governance.
Yeah, they are literally dictating that the governing body of a firm is now explicitly responsible for establishing and communicating a sound risk culture.
A sound risk culture.
Right. Plus, large and complex firms, so your domestic firms in categories 1, 2, and 5, they now must have a dedicated, fully independent risk management function.
Wait, so let me stop you there. In attendance, that's the linchpin here.
Oh, absolutely. Historically, you had this decentralized approach where traders and loan officers were sort of supposed to manage their own risk as they were generating revenue.
Which sounds like a terrible idea in hindsight.
Yeah, regulators realized pretty quickly that if everyone is supposedly responsible for risk, then no one is actually responsible for risk.
Right.
You need a dedicated function that is just entirely detached from the pressure to, close deals and hit quarterly profit targets.
So, okay, is this instead of relying on a few fire extinguishers scattered in the hallway for everyone to use, you suddenly have to hire a full-time independent fire chief?
Yes. A fire chief who reports directly to the building owner, but with one really crucial difference. This fire chief doesn't just put out fires. They actually have the power to stop the building from being constructed in the first place.
Oh, wow. So they can just say no to a deal?
Completely. They can look at a highly profitable new trading strategy and just veto it because the underlying tail risks are too extreme.
That's a massive power dynamic shift.
It is. And that dynamic is exactly why your earlier point about a sound risk culture isn't just, corporate buzzword bingo. Regulators know culture can be a really fuzzy concept.
Yeah, I was going to push back on that. Because how do you actually regulate a vibe? If the board just slaps sound risk culture on a PowerPoint slide, how does the DFSA audit that?
Well, they do it by weaponizing the internal audit function. Under these new rules, internal audit must specifically review the governance and risk management arrangements.
Ah, okay.
Yeah, so it transforms culture into a highly auditable metric. The auditors will actually look at whether the risk management function is adequately resourced.
So they're checking the receipts.
Exactly. They'll look at board meeting minutes. If a deal maker brings a massively risky proposal to the table, does the chief risk officer have an equal voice, or are they just consistently overruled?
Right. So if the fire chief is being ignored, that's no longer just a bad internal dynamic?
No, it is a direct regulatory violation.
Wow. And, looking at the feedback the DFSA received on this CP 167 document, the industry definitely felt the weight of that.
Oh, they definitely push back.
Yeah, they pushed back quite a bit on who exactly gets to be this all-powerful fire chief because the initial draft said it had to be a senior manager, right?
Right, but the DFSA actually listened to the feedback on that one. They updated the rules so the head of risk can now be a director or a partner.
Which makes sense.
Yeah, that concession is really just about the reality of how different firms are structured. The DFSA looked at how they already handle the finance officer function and just applied the same logic.
Because in a lot of partnerships, a partner has way more operational clout than someone with just a senior manager title.
Exactly. The regulator is basically saying they don't care about the specific title on the business card. They just care that the person holding the hose has the absolute highest level of authority.
And they also showed some flexibility regarding specific business models, didn't they?
They did, yeah.
Like, based on that other rule change, CP 161, I think firms that are classified as matched principals and got moved into Category 2, they're completely exempt from this specific requirement to have that dedicated head of risk.
Yeah, and that comes down to regulating the actual danger rather than just, applying a blanket rule.
Right.
A matched principal firm isn't really holding massive directional market risk overnight. They just sit between a buyer and a seller, execute the trade, and step out.
So their risk profile is incredibly constrained compared to, say, a massive investment bank taking proprietary positions.
Precisely. Forcing them to hire an expensive, fully independent risk apparatus would just crush their operating model without actually providing any real systemic safety.
Makes total sense. But for the firms that do require this apparatus, the radar is expanding massively.
Oh, hugely.
Because the rulebook is demanding that risk management explicitly cover emerging threats now. We aren't just looking at whether a client will default on a loan tomorrow.
No, it's way broader.
We're talking about embedding things like climate change and digitalization into the very foundation of how banks assess themselves, like their ICAP, their internal capital adequacy assessment process, and their stress testing.
Yeah, and their overall risk appetite. I mean, the inclusion of climate change into formal stress testing is just a monumental shift in banking mathematics.
Wait, really? How so?
Well, for decades, banks just treated climate change as an abstract reputational issue. But now the DFSA is forcing them to treat it as a quantifiable balance sheet risk. They have to model physical risks and transition risks over decades.
Okay, walk me through how a bank actually stress tests for the climate. Like, if I have a loan book, how do I model the weather?
Okay, so let's say your bank has a massive portfolio of 30-year commercial mortgages on coastal real estate developments.
Yeah.
That's a physical risk. The bank must now run models factoring in projected sea level rises or, the increased frequency of Category 5 hurricanes over the lifespan of those specific loans.
Wow. So if extreme weather makes those properties uninsurable in 15 years, the value of your collateral just plummets.
Exactly. And then you have transition risk.
Hmm.
Say your bank lends heavily to heavy manufacturing or like fossil fuel extraction.
Yeah, right.
You now have to build economic models simulating what happens to those companies' ability to repay their debt if governments suddenly enact a sweeping carbon tax.
So the bank actually has to prove they hold enough capital today to survive those specific future scenarios.
Yes, they have to prove it mathematically.
That is wild. And, the scope of what needs monitoring isn't just external stuff like the climate. The new rules dictate that any modifications to existing products must go through the formal new product approval process.
Right, you can't just sneak changes through anymore.
Yeah, and any major business model changes require the governing body's direct approval. You can't just quietly take a vanilla savings product, add a tiny bit of leverage to it to boost yields, and roll it out.
No, definitely not. But here's the thing. To track all of this, the climate models, the mutating products, the daily trading risks, you need an unprecedented amount of data.
Right. Which brings us to the tech side of things. The DFSA is coming down incredibly hard on risk data aggregation.
Yeah, this is arguably the most technically demanding part of the entire regulatory update. The regulators are directly targeting the legacy IT architecture inside these institutions.
So it's essentially like a 5,000-piece puzzle. You can have all the data points scattered across the firm, but if your computer systems don't talk to each other fast enough, you don't have the picture on the box.
That's a great way to put it.
By the time you manually compile the spreadsheet to see the storm forming, it's already raining.
And that exact scenario is why this rule exists. I mean, the feedback the DFSA provided here points directly back to the catastrophic failures of the 2008 global financial crisis.
Oh, really? They actually referenced 2008.
Yeah. Smaller firms actually asked for more leniency or, specific guidelines on data aggregation.
Yeah.
And the DFSA firmly pointed them to the Basel Committee's principles from January 2013 and a follow-up newsletter from January 2026.
Just a hard go read the rules.
Pretty much. Because during the 2008 crisis, major global banks literally could not answer the question, what is our firm-wide exposure to Lehman Brothers?
Because the derivatives desk was probably running on software from 1998, and the commercial lending desk was on a completely different system.
Exactly. The data existed, but it was siloed in completely incompatible formats across dozens of different geographic branches.
So it took weeks to manually aggregate the puzzle pieces.
Yes. And the new expectation is that a bank's IT infrastructure must be able to aggregate risk exposures instantaneously across all business lines.
So the governing body knows its exact vulnerability at the push of a button.
Exactly. And if your systems can't do that, you are in breach of the rules.
Okay, so if we are moving from these high-tech, instantaneous data systems and climate models, it brings into sharp focus how banks handle the oldest risk in their playbook, right? Lending money.
Oh, absolutely. The bedrock of banking.
Because the rules regarding credit risk and how banks provision for bad loans are undergoing a complete overhaul here.
Yeah, this is vital for financial stability. The entire concept of a bank relies on their ability to absorb losses when borrowers inevitably, fail to pay them back.
Right. And reading the feedback statement, it looks like the DFSA is completely throwing out the old method of minimum provisioning that was based on past due days.
Yeah, the old incurred loss model is gone.
Wait, so under that old model, were they essentially just waiting for a client to miss a payment or hit a 90-day past due threshold before officially recognizing the loss and setting aside capital?
Pretty much, yeah.
I mean, isn't that like waiting for your car's engine to start smoking and sputtering before you decide it might be a good time to check the oil?
That is exactly what it was like. It was a deeply flawed reactive system. Because by waiting for the triggering event, the smoke from the engine banks were just constantly behind the curve.
Wow.
So when an economic downturn hit, thousands of loans would hit that past due threshold simultaneously.
Oh, I see.
Yeah, and banks were suddenly forced to recognize massive catastrophic losses all at once, which depleted their capital precisely when it was hardest to raise more. It really amplified the financial crisis.
So what is the new mechanism? How do they check the oil before the smoke starts?
They are aligning the regulatory rulebook with IFRS 9, which is the expected credit loss framework.
Expected credit loss. Okay.
Yep. Yeah. Under this model, the bank has to provision for a loss on the very day they issue the loan. They don't wait for a missed payment at all.
Wait, really? Day one?
Day one. They have to input forward-looking indicators. So projected GDP growth, unemployment curves, inflation expectations into a predictive model.
Okay, so if the macroeconomic forecast suggests a 2% chance that loans in a certain sector will default over the next year, the bank must immediately set aside capital to cover that expected loss.
Exactly. It forces institutions to build their safety buffers during the good times.
That makes a lot of sense. And the DFSA is also setting very strict boundaries on what kind of money can count toward a bank's regulatory safety buffer, right? Their Tier 2 capitals.
Yes, very strict.
The rules state that only Stage 1 provisions under IFRS 9 are eligible, and they are strictly capped at 1.25% of credit risk-weighted assets.
Right. And the math here is highly intentional. Under IFRS 9, a Stage 1 loan is a healthy performing loan where the credit risk hasn't significantly increased since it was issued.
Okay.
So the bank has set aside a small expected loss provision for it, just in case. Regulators will allow banks to count a capped portion of that specific provision toward their general Tier 2 regulatory capital because it acts as a genuine rainy day fund.
But the moment a loan's risk profile degrades and it moves to Stage 2 or Stage 3.
That provision is now earmarked for a highly probable specific loss.
Got it. So the DFSA is making sure banks don't double count money that is already spoken for as a general safety cushion.
Precisely.
And this level of detail spills over into how these exposures are classified and presented to the board. Because the new rules explicitly require banks to categorize exposures into performing, past due, non-performing, and forborne.
Right. With forborne being those loans where the bank had to throw a lifeline and modify the repayment terms for a struggling borrower.
Yeah. And this new matrix is being introduced alongside the older 5-category system of standard, special mention, substandard, doubtful, and loss. I mean, you can imagine compliance officers panicking about how to build that dashboard for the board of directors.
Well, they definitely panicked. During the feedback phase, industry respondents heavily voiced that exact concern. They basically asked if they were legally required to present this massive, convoluted matrix of overlapping classifications at every single board meeting.
Did the DFSA back down?
Well, they offered a very pragmatic clarification. They stated that the regulation doesn't dictate the exact formatting of the internal reports. The goal is meaningful oversight.
So if a firm's board grasps the health of the portfolio better using the old 5-category system, they can still use that.
Yes, as long as the underlying data maps to the new requirements. The mandate isn't about rigid formatting, it's about ensuring the governing body cannot claim they didn't understand the true health of their loan book.
No plausible deniability.
Exactly.
And the scope of what they have to monitor within that loan book is expanding under the definition of concentration risk, too. It's no longer just a matter of large exposures, like, making sure you don't lend 40% of your capital to one single corporate conglomerate.
Right, the definition of concentration risk is radically broader now. It explicitly includes excessive exposure to specific asset classes, currencies, funding sources, or geographic regions.
Which is huge.
It is. You could have a loan book perfectly diversified across 1,000 different unconnected clients. But if every single one of those clients is a mid-tier commercial real estate developer in the exact same municipal district, you have a massive unmitigated concentration risk.
Right, because if that specific local property market experiences a downturn, your entire diversified portfolio defaults simultaneously.
Exactly.
Okay, let's unpack this a bit more. Because if regulators are placing these strict geographic and sector limits on normal clients to prevent systemic failure, it naturally raises the question of how banks treat their own VIPs.
Oh yes, this is a big one.
If you can't load up on too much commercial real estate in one zip code, surely you can't just hand out massive unchecked loans to your own subsidiaries and executives. Which brings us to the new rules surrounding related person transactions.
Yeah, this is where the regulatory update becomes acutely personal for the executives and board members running these institutions.
Yeah.
A related party transaction is inherently fraught with conflicts of interest.
Because it's the bank doing business with itself, essentially.
Right, itself, its executives, or entities controlled by its major shareholders.
So to eliminate the gray area, the DFSA introduced a hard mathematical definition of an affiliate. It now explicitly covers entities where the firm holds between 20% and 50% of the shares or voting rights.
Yes.
And in their feedback update, they confirmed this strict definition applies specifically to the Prudential Investment Business Module, the PIB module for a related person, so it doesn't accidentally disrupt other areas of corporate law.
Right, and by drawing that hard line at 20%, they are eliminating a classic loophole.
How so?
Well, historically, a bank might have an entity where they hold, say, 25% stake and argue, well, we don't hold a majority, so they aren't truly a related party. We don't need to subject this transaction to maximum scrutiny. The regulator is ending that debate right now. If you hold 20%, you have significant influence. It is a related party, full stop.
And the rules dictate that the arm's length requirement, meaning you have to treat them with the exact same strictness and pricing as a complete stranger off the street, now applies to all transactions, not just credit facilities.
Yes, everything.
So it covers consulting services, asset transfers, IT contracts. But I think the most revealing part of the feedback statement was how firms reacted to the approval process. Industry respondents actually formally requested the ability to delegate approvals.
They really tried.
Yeah, they wanted lower-level management committees to retain the power to approve big write-offs or large exposures to these related persons. And the DFSA gave an absolute non-negotiable no.
The DFSA was incredibly firm on this. For any transaction above the specified materiality thresholds, the governing body must directly approve it.
Wow, so it's essentially like making the parents physically review the expense, sign the permission slip, and write the check themselves, rather than letting the older sibling forge the signature and slide it through the system.
That is a perfect analogy.
There is no rubber stamping by a subcommittee.
None. And if we look at the history of financial collapses, you see exactly why this non-delegation rule exists. When regulators investigate a bank failure and uncover, a disastrous, heavily subsidized loan made to a CEO's side business,
Right.
the board of directors almost universally relies on plausible deniability. They throw their hands up and claim the internal credit subcommittee approved it without their knowledge.
The older sibling forged the signature.
Precisely. So by stripping away the ability to delegate, the DFSA is entirely removing that plausible deniability.
Wow.
If a highly questionable transaction with an affiliate goes through, the regulators are going to look at the document, and the board members' signatures will physically be on it. They are legally and professionally accountable.
Which makes the timeline for all of this incredibly urgent. I mean, you are talking about upgrading legacy IT architectures to solve the data aggregation puzzle, building forward-looking macroeconomic models for IFRS 9, and completely restructuring corporate governance approvals.
A massive undertaking.
Originally, this was all supposed to roll out on July 2, 2026. But recognizing the sheer scale of the operational overhaul, and because the rules were officially enacted in April 2026, the DFSA pushed the implementation date to January 1st, 2027.
And honestly, firms are going to need every single day of that runway. Getting the computer systems to talk to each other is a massive capital expenditure on its own.
Yeah, I bet.
But rewiring the culture of a board of directors so that they are actively interrogating climate models and personally signing off on affiliate IT contracts, that is a monumental behavioral shift.
And that behavioral shift is really the perfect place to leave you, the listener, today. We started this deep dive looking at the architectural rules of financial stability, but when you look at the mechanics of what the DFSA is actually doing, stripping away the ability to delegate, forcing the governing body to personally oversee everything from 30-year sea-level projections to insider loan write-offs, it raises a profound question.
It really does.
How does this change the fundamental nature of who is willing to sit on the board of a major financial institution?
I mean, the era of the prestige board seat, where an executive takes a lucrative, low-stress advisory role in retirement, is effectively over.
Yeah, if your signature is required on the line and you are acting as the ultimate legally liable fire chief for a multi-billion-dollar entity, the board seat morphs from a cushy reward into a high-stakes liability trap.
Absolutely.
The level of technical expertise and personal risk tolerance required to accept that job is going to fundamentally change the demographics of corporate leadership. It's definitely something to closely watch as governance evolves in the DIFC and globally over the next decade. Keep looking beneath the surface.